Let us look at this balanced portfolio consisting of 60% equities and 40% bonds. Right, we look at the 1 year look ahead period, 3 years look ahead period, and 5 years look ahead period. So in October 1987, when the stock market crashed, 1 year after, markets rebounded by 19%. 3 years after, rebounded by 32%, and 5 years after, 61%. Right? It is not difficult to observe that sometimes in the 1 year or 3 years look ahead period, markets actually continue to fall, right? But when we look at the 5 years look ahead period, we are always looking at very positive returns. So this again tells us how important it is, to not respond to the market crisis and stay invested, stay in the market for the long run. Okay, so this is the next slide, a graphical representation of what Professor Burton from Princeton University actually said earlier on, whereby most of the time, markets are actually going up, and there will be short bursts of time, where markets will be on a decline, right? It is not difficult to observe over here that, markets go up most of the time and for extended period, but there will be some times, when market will actually go down. So it is important that we stay invested over the long run, and during this short burst of market decline, we stay invested as well. And sometimes if, let's say, we have got enough funds, enough emergency funds set aside, it is actually a good time to invest. Okay, whenever there is a market decline, or whenever markets reach new high, people will be thinking whether is it a good time to invest. When markets go down, they feel that markets has not reached the bottom yet. And when markets actually rally and reach new high, investors feel that a correction will be coming. But let's look at the data and let's look at how markets react after a decline. So consider this chart here shows the S&P 500, from 1926 all the way up to 2022. So what they did is that every time when market decline more than 10%, they will record it. And they take all the periods when markets decline more than 10%, and they look at the 1 year look ahead period, 3 years look ahead period, and 5 years look ahead period. And they average out the returns in all those instances when markets actually decline more than 10%. And they found out that the 1 year look ahead period, the average 1 year look ahead period for the time when the S&P 500 recorded a more than 10% decline is actually 11.4%. For 3 years look ahead period, 10%, and the 5 years look ahead period is 9.6%. So from this, we can safely conclude that whenever markets decline, it always recovers, right? What about the average analyzed return when markets reach new high? 13.7%, it continues to go up after 1 year. 3 year look ahead period, 10.6%. And 5 year look ahead period, 10.2%. Again, whenever markets reach new high, it continues to go up. Yes, probably there may be some short correction, but when we stay invested for the long run, statistics shows us that we will be rewarded.